Wanted to do some introductions. I'm Charley Conkling, Chief Underwriter with Walker & Dunlop. I'll be the moderator on the panel, on our affordable LIHTC housing panel. I just want to introduce over to my far right here, Ken Dureski, Senior Underwriter in Minneapolis HUD and Acting Program Officer of Affordable Programs. Ken replaced Liz Artiega and is overseeing the production, preservation of FHA-insured multifamily housing developed with tax credits and provides technical assistance nationwide. Prior to HUD, Ken worked for 5 years at Minnesota Housing Finance Agency. And then to my immediate right, Joe McNeely, Underwriting Branch Chief in Boston, also designated LIHTC Pilot Underwriter. And to my immediate left, Mike Bazance, he's the Vice President, Deputy Chief Underwriter with Doherty. He's also the chair of the MBA LIHTC Committee. He has extensive experience underwriting and closing affordable transactions. And then Kent Newman, he's an attorney and the founding member with Tiber Hudson. He's been in the affordable and healthcare business for over 21 years. And Kent has been instrumental in creating and developing many of the financial structures used today in housing and healthcare industries. And I will hand this over to Ken Dureski to start going through his slides.
All right, thank you for sticking with us today, and thank you, Charlie, for having me. Pleasure to be here in Baltimore at the Eastern Lenders Conference. I believe, I cannot see it exactly, but I think, where are we? I think we need to go forward.
Ken, if you do want to, if you prefer.
Oh, no, that's okay. We're going to, Joe and I are actually going to kind of go back and forth on a few of these slides. So, but if you have any questions during our presentation, feel free to ask them, or we can take questions afterwards, of course. So, our first slide I just wanted to touch on was the fiscal year 2019. Actually, the items we're going to be discussing today are the fiscal year 2019 LIHTC data, and this is only for LIHTC projects. So please keep that in mind. We're going to discuss a little bit of comparison between what we've seen so far in 2020 versus 2019. We're going to talk about our experience in the Northeast region and talk about some instances of flexibility we've had with the LIHTC pilot project and summarize the pilot projects to date. And we're going to touch on opportunity zones, which we've been discussing basically all day or all afternoon, so it'll just be some more consistent data with that. So the first slide is for fiscal year 2019, and this is a total of LIHTC projects or LIHTC firm commitments issued or reissued. It's our basic FHA program and the risk share program as well. So for 2019, we issued 259 firm commitments. This was a reduction from 2018, approximately 24% reduction, and we also saw a reduction in our volume. However, please keep in mind that this data includes the entire fiscal year of 2019, and so that includes the 37-day government shutdown. So I know that Pat provided some information earlier, and she kind of netted that out. However, in this data, it does include the government shutdown, so please keep that in mind.
And I'll also add that rates increased as well, so I think that was a partial contribution.
Yes, absolutely. There were other factors. I just wanted to make sure that people were aware of that fact, because that is kind of a theme throughout, and things like increased rates and so forth. Now we're getting decreased rates. I'm sure our volume will be going up as long as our credit pricing stays good. So the next slide here is firms commitments issued, is the percentage of all of our projects. The LIHTC projects, we issued 35% of our firm commitments. Oh, have we got a problem? Did I mess up something? Up. All right. No, right before that. Thank you. Thank you very much. The arrow. Okay. Sorry. User error. I bet everybody's experienced that. So 35% of all of our firm commitments in 2019 were for LIHTC projects. So we are doing a pretty significant volume in the LIHTC business. And the loan volume altogether is approximately 26% of all of our deals in 2019.
Yeah, and Ken, just to add to that,
Yes.
I was looking back at the 2018 figures, and around 32% of all the business was LIHTC production compared to 35. So there's, from a percentage perspective, it ticked up slightly.
Yeah, thank you. So this slide breaks down all of our LIHTC firm commitments issued by sections of the Act. So like I said earlier, we've issued 259 firms in 2019 fiscal year. 103 were for 4% deals, 156 9% deals, did over 35,000 units, and $3.4 billion of loan insurance. Now, there is this pretty significant amount of these projects are risk share projects. As you can see, 77 were risk share projects, so $1.2 billion worth of loan volume were from the risk share program.
Right.
And a significant number of those are from the Northeast region, which Joe will touch on in a bit,
Right.
unless you had anything you wanted to add there.
And just to add to that, I will say, there was 182 non-risk share deals. The average loan size was right around 13 million, and approximately 46% of the non-risk share deals were Fs, 28% were sub-rehab, and 23% were new construction.
Okay. This next slide shows our firm commitments issued by region. As you can see here, the Northeast has issued the most firm commitments. However, 53 of those were for the risk share program. So there was a significant number of risk share projects there. And the Midwest region also has a number of risk share projects in addition to the West. Okay, this next slide is regarding our time frames. Please keep in mind again that this is just the LIHTC projects. It also includes the 37-day government shutdown. So that's a big contributor here, as well as and these are average days. There was a few outliers that really pushed up our average days. So D4, new construction, we were looking at 97 days. Sub-rehabs, 88 days. And then the rest of the business is really from the 223F program, and that averaged 67 days. But please keep in mind that this includes some outliers and the government shutdown. It's my understanding, and I've been hearing anecdotally from folks that they're actually receiving firm commitments in a much faster time frame than this. So correct me if I'm wrong. Maybe you had an outlier out there. But it's my understanding, and talking to Charley and so forth, that we've really had a lot of success, really, in meeting the time frames.
Right, I would agree. As long as the package is in good shape and you don't have a critical issue, then they've been meeting or exceeding the time frames.
This next slide just shows our fiscal year 2019 LIHTC endorsements. So again, it was down as a percentage from 2018. However, I think that the government shutdown and, like Charley said, the rate increase threw us off a bit there. We are seeing, and I'll get to this, but we are seeing increases in 2020 so far.
Ken, do you guys keep track of 241s? We're starting to see more of those in the marketplace.
I don't believe we did any LIHTC 241s that I recall in fiscal year 2019.
Okay.
Correct me if I'm wrong?
I think we worked on a few, but they may not have been processes. I'm not sure how they process them as LIHTC or not.
And just remember the HUD's fiscal year ends September, too.
Fair enough. Yes, true.
Yeah. And these next few, at least the next slide or two will be, Joe is going to present. So thank you.
So what we're presenting here is the FY19 New England Region LIHTC Firms. What we're trying to show is the breakdown among the different sections of the Act, including the risk share. This shows that we're doing primarily the bulk of our risk share business with the HFAs and the risk share program. It's a means of getting affordable housing built in cities like New York, Baltimore. We do some in Virginia and Washington, D.C., and most of our new construction LIHTC deals are done in Massachusetts and New Hampshire. About half of this is from New York City, in that LIHTC line. Their deals are very large. So we're seeing FHA deals done across the entire spectrum of the primary FHA application process. We're pushing out a lot of units, and it's one of our goals to create affordable units through our FHA program, and the New England region leads the country in the number of units that are created. And you can see that the basis of that achievement is the LIHTC program through the risk share program.
And Joe, just looking at the non-risk share deals, it looks like 39% of the deals are sub-rehab, 36 are Fs, and then 22% are new construction. Any issues that delay timing or place the deals on preliminary hold? Anything that we should be on the lookout for, or any issues that you've noticed?
Well, for the most part, the processing of a D4 LIHTC application is somewhat more swift than without the LIHTC, because there is less risk involved. We're dealing with properties that are, for the most part, they're already in our portfolio, especially for the sub-rehab program. So we have a track record with both the owner. Primarily, we're dealing with the general contractor that's doing the work. So there's a lot of familiarity there that we can capitalize on in the review process. And I'm not aware of too many issues. It's really a better fit for us to process this way.
Great.
Just for folks, who does 542C deals in the audience? Is there anybody that does risk share? Anyone from? Okay, so I could talk badly about them. Just so folks, because most of the folks I imagine are map lenders, the two big things we see, well, three big things we see with risk share versus map is that a lot of the issuers are actually restricting the deals, especially on affordable, to having to use risk share. So I don't know it's really a fair balancing for comparisons. The other two benefits that risk share has that map doesn't have yet is the ability to do a forward commitment on risk share and not trigger Davis-Bacon. You can't do that in HUD, and then with a map. And the other is you can actually balloon the debt after 16 to 18 years, which allows for advantages to take advantage of yield curves, so you're not going out all the way for 35 or 40-year terms. So there are some benefits to the risk share program. We're trying slowly to see if we can get those implemented in the map space as well, but I think that is part of the dynamic that we're seeing, and especially in the Northeast, why we see more and more of those deals becoming more popular.
What I'd add to that is there is no high cost factor involved in the risk share program, so that is one of the problems that are avoided with the risk share. So and that's a major factor, because in New England, around the Boston area, you can draw a circle around Boston for 90 miles, and we'll hit the capital cities of Providence, Hartford, Manchester, Concord, and just outside of Montpelier. and we're still like 5 hours from Augusta. But in that 90-mile radius, we haven't had any D4s come in the last 4 years that have penetrated that area. Most of these deals that are D4s are in parts of Connecticut and parts of New Hampshire and parts of Maine that are outside that ring. So almost all of these risk-share deals are inside that circle, and it's because of the high cost factor. I would say is the primary reason why there's no D4 activity in that range. Am I doing the next one?
No, no. All right. As I alluded to, this is a comparison from our first quarter 2019 to first quarter 2020 for our main programs, the D4 and F program. We have done issued a few more firms in that period and increased the volume by around $150 million. So it was ticking up slightly. However, we did have the government shutdown during the first quarter of 2019 when things weren't submitted or weren't issued, firm commitments weren't being issued then. However, in my own experience, I had at least one project where I think the day or 2 days after we got back to the office, I was able to issue a firm commitment. So it was still issued in the first quarter, even though we did have the shutdown. So I think there was a lot of that. I think we were able to still get firm commitments issued in a lot of cases. Okay. Our next slide is back to Joe.
Okay, so what we're showing here is the LIHTC Firms issued to date in 2020. So the takeaway from this slide is we're off the pace from last year, even though we had our shutdown, and there's no substantial reason for that. Our business is basically the will of the owners and the lenders to come into the FHA program. We don't go out and do any marketing, so we can't look at it, see if our advertising is off or our message is off. It's just the business is off a little bit. There has been a spike this month. We're seeing more A7s come in. I haven't checked to see if they're LIHTC deals yet or not, but that's what the impression we want to leave you with this slide here is we're in March, we're halfway through the fiscal year, and we're looking at a little bit of a trend down from last year.
And if you exclude the risk share deals, I think the volume's pretty similar on the non-risk share deals when I was looking at it.
And one other factor, just to kind of as a comparison in the landscape for affordable, some of the other programs, including GSEs and bank private placement programs, have started actually doing 40-year amortization to try to compete with the HUD products. So that's another thing we're seeing where there's been more competition. HUD used to be the primary way to max out proceeds and get longer-term debt. There are other programs now with interest rates where they are and longer amortization to try to compete at that level.
Okay, back to you.
Our next slide here is a summary of our LIHTC project pilot program to date. So I've included fiscal year 2019 and fiscal year 2020. So overall, we've done 11 deals. Now, it did take a bit to, after the notice was published, to ramp up and actually get some deals in our pipeline and get them processed. And our fiscal year ends at the end of September. So we did 3 in 2019 and 8 so far in 2020. Now, I'm aware of another project that is going to have a LIHTC Pilot Loan Committee meeting next week. So that would get us up to 12. The loan volume overall has been about $88 million, and our units are over 1,000. And so far, we've endorsed 5 of those loans, and we have another one of my own projects in Mike's that is endorsing on Tuesday of next week. So, so we haven't done a tremendous amount of deals. We have done 11. I would ask that all of you try to get some deals in our pipeline for the LIHTC program. We're having a very great success on our average turnaround times. We're looking at in fiscal year 2020 so far, 27 days turnaround for our expedited deals. And our standard deals are a little bit over our DAS goal. However, there was one project that was an outlier that had a project on hold, or it had some time on hold that average pushed us over that 60 days. So, but I would say overall, it's been successful, and I would really encourage everyone out there to drum up some LIHTC pilot business and send it our way.
And Ken, just a reminder to the industry, there's a $250 million cap on the LIHTC pilot production. Based on the current volume and projecting out, I'm projecting around 180 million. So it doesn't look like we're going to bump up against the cap, but if we get a bunch of deals, who knows? If we do get close to the cap, is there an ability to increase the volume at the end of the year?
Yes, at headquarters we can request additional commitment authority if we were to run up against the $250 million cap. It's not a certainty, however, I understand that there would be some willingness to consider that.
And is there anything else or more the industry can do with assisting HUD with processing these pilot deals?
Try to bring us clean deals. We'll make sure we get them done in our time frame, but I think everyone does a pretty good job of that anyways. So really appreciate those that have submitted projects to the pilot program. Oh, yes, sorry. I really appreciate those that have submitted projects through the pilot program, and we're here to try to serve you and make sure we get those done as quickly as possible.
And Ken, if you don't mind, I'd like to just talk a little bit about some of the feedback that Mike and I are with the MBA LIHTC Committee. We have been asking for people to let us, we've sent out spreadsheets with just some data points on these LIHTC pilot deals, and one of the attachments in the app is a summary of all the pilot deals and the case studies that we reviewed. And if you open it up, just in summary, we have 9 case studies with 5 firm commitments issued and 4 in process. 5 are 9% deals, 4 are 4% deals, 7 are expedited, and 2 are standard. Most of them are sub-rehabs. The average loan size is around 11 million, and the average debt service coverage is around 128, and the average loan to value is 49%. But our processing timeframes are pretty similar to what you just mentioned. For expedited, it was 25 days, and standard, it was 43, so much quicker on the standard. Maybe the outlier was throwing it off.
Yeah, 43 days, that's great. And these next 2 slides, Joe is going to take over for me. Thank you.
So we have issued a pilot notice, and we are cognizant of that $250 million cap. And at the outset, we wanted to be flexible in working with the lenders and the owners to get deals into the pilot program. So we have several applications that didn't meet the letter of the requirements in the notice. So what we had was an application that came in Benson's Corner. It was a new construction. Its affordability rate was 89.28% on I think it was a 56-unit property. So it was 1 unit off from it meeting the requirement, and we allowed that to proceed because it was close enough to the 90% affordability requirement. The interesting aspect of allowing it to proceed as an affordable project under the pilot was that we didn't allow it to get the lower MIP for a broadly affordable property. So that was a fine distinction in that. And we were able to issue the firm commitment on that a couple of weeks ago. We had another one, environmental issues are a primary concern of the readiness to proceed in the LIHTC application for the pilot program. One of them had a 8-step process that needed to be completed, And we looked at that as something that we could overlook and work through, mainly because we did the standard processing on that application. So that became something that we can find some flexibility in. We had another property that was done in the southeast region, a sub-rehab. So the loan-to-cost threshold is 75%, and as you can see from the slide, this one came in at 76.13. So we're not trying to be rigid and strict. We're splitting some understandings of what's the requirement versus what the need is, and we're looking at these flexibilities of trying to get this program to work and working with the owners and the lenders to get projects into the application process. So we also had another one that came in. It was Midlothian Town Center, I think the name of it was. It's a RAD application. We had put it through the concept meeting process, issued it a letter to invite it to come in straight to firm for a standard processing. That was done in May timeframe, and in July it looked like they weren't going to be able to submit their application and meet the closing requirement that we're trying to establish as part of the pilot notice. So that application was withdrawn. It actually came in much later, and we issued the firm outside of the pilot. It was actually a 47-day review because we had already had a pretty good handle on that sub-rehab application, and so it proved that RAD is a little bit dicier. But then I'm told that we're now considering another application in the southeast region that's a RAD component.
Yep, Southwest. Yep.
Southwest, sorry.
No worries.
And so we'll try and give it another shot to see if we can get that into the pilot program.
Thank you, Joe. These next two slides, we're switching gears here a little bit, talk about a few of the Chapter 14 map guide highlights. I'm sure many of you are aware of these changes that we're planning. You know, some of this was driven by the MBA LIHTC Committee, which I appreciate working with those folks through the Chapter 14 changes. The first is, and I'm just highlighting a few of the changes. There were many other changes. However, just tried to pull out a few, and maybe Mike or Charlie might have some others to highlight. But the first is the initial operating deficit. That was, I'm sure you're well aware, required to be fully funded at initial endorsement. We're now relaxing that requirement to allow the IOD to be provided at the time that HUD signs off on the permission to occupy. So in other words, at substantial completion, rather than at initial endorsement. The second is the working capital escrow. In this case, we're eliminating the requirement of a working capital escrow, and this is without a HUD 2 waiver for sub-rehab projects with 90% plus Section 8 and 90% LIHTC when the lender can demonstrate there'll be sufficient income generated during the rehab period to cover the items that are typically funded by the working capital escrow. And when interim income is not being used as a source of financing. So if interim income is being used as a source of financing, we would maybe consider that under a waiver. But if it's not being used, then there would be no waiver required anymore for that. Go to the next slide here, and just a couple more items. In 1412E, we're allowing the deferred developer fee as eligible debt in a refinancing, except for in a 223A7. And this is subject to conditions, and that'll be outlined in the map guide, but nonetheless, going forward for 223Fs, for example, deferred developer fee will be eligible. 1413, and this is, I think clearly everyone is aware of this one. It's a big change, reducing the initial 20% equity pay-in from a hard 20% equity to a minimum of 10% equity, with the other 10% provided with an equity bridge loan or an equity bridge loan proceeds. Now, you may have a situation where you're putting in 15% hard equity and 5% bridge loan. That'll be fine as well. But in general, reducing that minimum to 10%. And another important one in 1414E, we're extending the equity bridge loan repayment. Currently that's due at final endorsement for a D4 or I think, when is it due for an F?
1 year after
Yeah, repair completion, right. Now we're changing it to 1 year after final endorsement and 1 year after repair completion, or the completion period. So 1 year after the 12-month escrow repair period. And besides that, we just made several clarifications and minor changes, and Charlie and Mike might have some other comments on that, I'm not sure. These last few slides are, and everyone's heard this already today, but just a few summary slides of our Opportunity Zone projects. And this one actually, there was a couple of minor mistakes in these slides. They'll be corrected with Charlie's final version that'll be posted on the ELA website. So I was just trying to make some final last-minute changes before this was due, and we've actually issued 42 firm commitments rather than 41 that is noted here on the slide. Over 7,000 units and over $1 billion in total loan volume. And this is as of March 2nd. I know we've gotten a couple more deals here this week, but I haven't been able to identify exactly which, if they were Fs or D4s yet. And the next slide here is by region. The mistake here in this slide is that the Midwest, we've done 6 total Opportunity Zone deals in the Midwest. However, 3 of them were Fs rather than 1 as noted in the slide. So my apologies for that. The most Opportunity Zone, the region that did the most Opportunity Zone projects was the Northeast region at 15. I don't know if Joe might want to mention something about that.
Well, there is somewhere in the vicinity of 8,000 opportunity zones in the United States, and more than a quarter of those are in the Northeast region. In some of our cities, you would pretty much have to go to the IRS website, look at your census tract where your property is, and you'll probably find out that it's in an opportunity zone. So what that allows you to do, and I know they went over this as a case study, but you do get a lower application fee with the opportunity zone, but it also allows the owner to create some kind of fund that's called a Qualified Opportunity Fund, where they can use the equity that they put in that's required for a new construction property or an F, and get another tax break on that. It's a self-applied tax break where it goes directly to the individual tax return of the investor. And that's something that is an inducement, and actually the only 2 inducements we have in the FHA program right now is to allow for the lower application fee and for the owner to drive some tax benefit through their equity pay into the property. And those are important features, because I don't know what the time frame is for the tax credit, but I believe it's at least 10 years, so you can reduce that tax credit for that length.
And I will add that we did have I'm in the Minneapolis HUD office, and we did have a project that came into our office, and the lender was actually unaware that the project was located in an opportunity zone. So I believe at the time I think once after we issue the firm commitment or the deal is closed, they will be requesting a refund of that, of the exam. So, and this last slide that I have, again, there's a couple of minor mistakes on here, but the total of firm commitments are 42. There was actually 14 new construction, D4 new construction projects, 8 sub-rehabs, which is correct on the slide, and 20 Fs, for a total of 42, like we've said. We had 23 affordable projects, and 19 were market rate projects. So, and with that, concludes my portion of the presentation. And Joe, thank you.
Thank you, Ken. Thank you, Joe. Ken, Q. Thank you. At the end, that works. Yep. All right. So I'm going to turn it over to Mike to go over the MBA LIHTC initiatives, the completed and the current initiatives. He's going to, we're going to skip over the completed initiatives, but before I have Mike go into the current initiatives, I'd like to just add to what Ken had discussed earlier and just highlight some of the several key changes in the new map guide. And Ken already covered some of these, so I'll just hit on some of the other items that worth mentioning. HUD's allowing flexibility on the use of contingency funds, so unused portions can be used to pay developer fee and other project-related costs. HUD's expanded the definition of public and quasi-public subordinate debt to include not-for-profit debt, and also clarified that private subordinate debt is allowed for LIHTC construction transactions. They've also clarified that the equity required up front and initial endorsement on construction deals must be dispersed from the equity investor. And HUD will also allow early release of the working capital in the IOD escrows after final endorsement and 6 consecutive months of break-even occupancy. So there's no longer the need to wait 12 months post final endorsement.
Thanks, Charlie. And those are, obviously really good improvements that we're really happy about. The LIHTC Committee, Charlie and I, and several others have been working with Liz and Ken, going through the map guide just to, make sure that what's in Chapter 14 really is, the best possible policy and really, help get LIHTC deals done more efficiently and drive more business to the HUD programs. So I'm here on behalf of the MBA LIHTC Committee. I'm this year's chair, and Charlie is this year's vice chair. The LIHTC Committee was really formed several years ago to, the main function was working through issues that came up on LIHTC deals. And a lot of those are in the completed initiative slides that we've skipped. But, where we're at now is there are fewer issues, and we see really our role as collaborating with HUD to try to make the programs better and work through issues as they come up. But we're appreciative of our partnership with Ken and the folks at headquarters. Our current initiatives now, it's a fairly lengthy list, and we're keeping ourselves busy, but initiative number 1, top priority is the 2020 map guide review. And, we spent a lot of time going through, consolidating comments, going through those with Ken, and I think, what is coming out in Chapter 14 that will be published in the final map guide, we believe is even better than what was issued in the draft, and we're excited about that. We've also been monitoring LIHTC-related provisions in the other chapters, so Chapter 7 and 8 had a few of those, and 3 and 13 likely will as well, and so Charlie and I are staying on top of those and working with Ken on those specific comments. Next initiative, and this is a big one, and Tom Bernasiak touched a little bit on it yesterday, but the 2018 Form of Subordination Agreement. As some folks are aware, there are a few HFAs throughout the country that have some issues with the new form that went into effect last May. We've been kind of coordinating those, consolidating those issues, and after working with Ken and Tom, we've been advised, and Tom indicated yesterday that there's a new form working its way through, clearance to be released for public comment. once that is released, we will be asking the members of our committee and lenders to be, sharing that new form with, HFAs with which you work to make sure that, they're reviewing and commenting, because we'd really like what is ultimately put into place for the subordination agreement to be something that's workable and doesn't have issues or deal stoppers in it. So that's something that we'll be on top of once that's released. The LIHTC Committee also formed what we called a Chapter 15 Markup to Market Working Group. That came out of some discussion at one of the other lender conferences about inconsistency between offices and coordination with asset management, of how HAP renewals are handled when there's a Chapter 15 in conjunction with HUD financing. Back in late 2018, we submitted a list of recommendations and what we considered best practices. With the MAP guide that had been put aside for a little bit, but Ken has picked that up along with some folks in the West region, and so we know that that's being worked on and taken under advisement. What I think is also in process is a standard comfort letter that will allow for firm applications to proceed on a, with preliminarily approved HAP rents prior to, HERO's review and other things that are part of the Chapter 15 being completed. So we're excited to see what comes out of that. We've also been involved working with the MBA and a group of lenders to start a D4 Underwriter training course. That's really designed to piggyback off the Underwriter training course that the MBA currently has, but to focus on 221 D4 and LIHTC transactions specifically. So, while this training course is not going to, be a substitute for, the experience requirements to be a MAP underwriter like the current course does, we're excited about the supplement that it will be to training, I think both for lender underwriters and for HUD. So we've had a few kickoff meetings. We've gotten a faculty established, and sections have been assigned, so we're working on developing that curriculum. If you're interested in being involved and you're not currently involved, please feel free to reach out to Terry Wellman about that. We're also actively monitoring the D4 pilot program, and while it's operating very smoothly, we like to serve as a resource in the event that there are issues or inconsistencies, and if we do receive feedback from a lender, we work with Ken to make sure that that gets resolved as it can be, and that's it's been a good working relationship there. One of the significant things that we did last year and that we continue to work on is responding to the executive order request for ways to eliminate barriers to affordable housing. The LIHTC Committee submitted a document to HUD, and it's actually included as one of the documents on the app for this panel, with a number of suggestions for eliminating barriers. There were some very large asks on there, like eliminating Davis-Bacon, and there were a number of very manageable asks, too, that have been incorporated into the new MAP guide. So, we continue to work with HUD on those items. I encourage you, if you haven't gotten a copy of that letter, to take a look at it. It's up on the app, but we think that's a good starting point, and really glad to see that the number of people who are looking at those recommendations. Next one, and Ken and Charley both touched on it a little bit, but deferred developer fee is eligible debt for a HUD refinance. We've been told that it will be an eligible debt to be included in eligible costs for a 223F, but not an A7. We're hoping to continue the conversation on including for A7, but think that the inclusion under 223F is a benefit for refinancing of tax credit deals. Next initiative relates to the use of some of the very positive provisions in Chapter 14 ahead of the MAP guide release. The draft Chapter 14 came out late last year, and a lot of us have been talking to our clients and developers about things like reduced initial equity pay-in, extended equity bridge loan terms, and with the MAP guide not coming out until possibly September, we will work with the work with HUD to do what we can in requesting the use of some of those provisions, because that is important to a lot of our business, and I know we'll be continuing that conversation. And then finally, just a few others before I hand it over to Kent here. Early release of working capital and operating deficit on all transactions. It's our understanding that language is being added to Chapter 12 of the new map guide. It wasn't in the draft, but we understand it's being added to the final version that softens the requirements on release of those escrows. Right now, it's currently the later of 6 months of break-even occupancy or 12 months after final endorsement. And sometimes that 12 months gets to be a little bit onerous if you have a property that's stabilized right away. So we expect some softening of the language there. We've also worked on the language in the map guide, trying to clarify the underwriting of Section 8 rents on a LIHTC deal for Criterion 5. As many of us are aware, if you don't have the same firm that does the rent comp study and the appraisal, there is often a discrepancy between the HAP rents that get submitted with your HAP renewal request and approved and the rents in your map appraisal. Usually it's not a significant difference, but a difference nonetheless, and so we were pleased to see the language come out in draft Chapter 7, allowing for the underwriting of approved HAP rents for recently renewed or new 20-year HAP contracts. So that's we see that as very positive. Something that's been talked about a little bit at the conference that we'll continue to monitor is workforce housing. Once the new map guide is released, we would really like to work with HUD to continue to find a way to incentivize naturally occurring affordable housing, whether that's through underwriting parameters or MIP. And we're excited that Lamar mentioned yesterday that the Secretary has formed a working group on that. And we think this is really the next step in improving HUD's programs and are excited to be part of that discussion. Opportunity zones, not too much to say on that. We were involved in the training that HUD put on for its staff last year, but we'd like to continue to be part of the conversation to see if any processes can be improved there. Then final initiatives, we're happy to be working with Ken. Ken, I know that you're almost at the end of your 120-day detail, but we're hopeful that you'll be staying on, and it sounds like you're going to be, so. I don't know. We're hoping so. I don't want to put you on the spot, but we're excited to have a staff member at HUD working with us, and then finally serving as a resource to our members. So we do have monthly calls. If you are not on the distribution list for our committee and would like to be, please see Charley or me, drop off a business card, and we'll be sure that we add you to the list, because we're here to be a resource to our members. And so with that, I think that covers what we're currently working on, and turn it back to Charley and Kent.
Yeah. Kent?
Oh, great. Good afternoon. I can use the arrows. Perfect. Good afternoon. I think I'm between you and cocktails, so I'm going to try to make this pretty fast. As you all know, we do a lot of bond transactions around the country. Last year we did over 150 deals. Lauren Marcus and Jim Peck, who I think is here, and myself and our team. It's pretty complicated stuff that adds on to some of these other HUD transactions. So we're always happy to set up calls. We often travel, but I know that's going to be limited in the next few months. So we're happy to do calls, and unlike most firms, we don't actually bill by the hour. So we're happy to go through this stuff in more detail if you're interested in learning about some of the latest things we're working on. I usually start out with talking about where interest rates are, but I don't really know, so I'm going to skip all of this stuff. They're very low. So from the permanent lending side, right, every developer should be closing as many HUD deals as possible. We think the product is the best out there today in the affordable space. We also do, the total yield curve is relatively flat, although there's been some steepness recently, so we're going to monitor that. I'll tell you the downside to that, oddly enough. When rates come down, it sounds like a good thing, but there's actually, no pun intended, a negative consequence to it on the types of bond deals we work on with HUD. I'll get into that in a minute. still the most popular execution was a structure we've created almost a decade ago that you're all very familiar with. I used to come to the conferences and have to show people how short-term bonds worked, and now everyone is very familiar with them, which is great. We still think there's a ton of benefits. The market conditions are still very solid and positive for using this. We're using it not just in FHA space, but also with rural development for 538 loans, taxable GSE loans, and we're actually doing short-term bonds just with very low-cost taxable debt that's in the marketplace. HUD has a lot of unique features. As I mentioned earlier, some other programs are starting to go with 40-year amortization, but most of them, other than FHA, still do 18-year terms, and that's to match up with the tax credit compliance period. So in order to get tax credits over a 15-year period, most of the equity investors are going to want fixed rate debt during that time, and then the structures are all designed for refinancings at 18 years. FHA does not have that. You always obviously can prepay, the borrower could, but they can keep it in place as well and keep these low interest rates in place. I'll mention one other benefit that it was just starting to pick up about 8 years ago. The exemption from what's called the 10-year hold rule was expanded beyond just Section 8. HUD debt is one of the ways now that we can put onto projects with bonds and credits and get what's called acquisition credits, which makes up a significant portion of tax credit equity that come into acquisition and preservation deals. So HUD is very unique in that regard. If you have developers that are buying an asset or own an asset that has not been held for 10 years, they may be precluded and are likely precluded if it's not Section 8 to get those acquisition credits. And that's, like I said, makes up for sometimes 80% of the equity in the deals. With putting HUD debt on there, it unlocks those acquisition credits again. So that's where FHA, we just closed, Laura and I closed a deal last month. We're working on a deal in Maryland now. We'll probably close about 15 deals just with this execution just to get the acquisition credit. So that's a thing you should be working on with your developers. Again, to summarize why you need to even talk to us and use bonds, it's part of the tax code that in order to get these 4% credits, which are becoming more competitive, by the way, many states, we're up to about 14 states that are either volume cap limited or constrained, and so it is becoming more competitive in the marketplace. But in order to get those 4% tax credits, you have to use at least 50% of the transaction costs have to be spent with tax-exempt bonds. And so we designed the structure, which I'm sure you've seen these animated slides before. It won't show up, of course, on a PDF, but if you want to email us, we can give you these. I'm going to go through this pretty fast. Bonds are fully issued day one. The bondholders hold these bonds for a short term, just till the project's complete. You guys, this is a D4 example. You fund your draws, they're called lender funds, to the bond trustee who swaps them out with the bond proceeds, each draw. Borrower gets to use those bond proceeds, which are both tax exempt, meeting the 50% test, and they're FHA insured. That process continues. It's a very fast construction and modular. And the last draw, oftentimes the FHA loan is larger than the bond amount needed. Once that project is complete, the trustee can use those bonds to pay off the collateral to pay off the bondholders, and the borrower pays debt service. So the borrower got qualified for tax credits, gets this extremely low taxable mortgage rate that you can provide, and all the benefits of FHA. As you saw in the example, there are many deals where the FHA loan is larger than the amount of the bonds. And that's, again, they're both calculated independently. The bond amount is based on that 50% test I mentioned, which is a calculation we can walk you through, basically 50% of total development costs. And the FHA loan obviously is sized based on your underwriting parameters. There are many cases and situations, especially in high cost areas, where the bonds you actually need to issue are greater than your FHA loan. Don't worry, we can pretty much solve that problem by supplementing the lender funds with other monies, tax credit equity, soft monies, and even seller notes. So we're able to solve that for the 50% test. There are many cost-saving features we've designed in this. We've done pooled financings. We've done as many as 6 to 10 FHA deals with one bond issuance. So if you have small deals and you need to spread those fixed costs, that's one way to do them. They obviously should be in the same state and close approximately at the same time, so that helps. There are no long-term bond-related fees, which is a good thing for the developers, bad thing for issuers. So we'll talk about that in a minute. Some issuers are now forcing developers to use a technology we've been using 10 years ago with long-term bond deals to get those fees. There are some benefits to doing the structure, the short-term structure. It boosts equity pricing and equity pans. And then finally, although it's an old bullet point at the bottom, it says no net interest cost. Unfortunately, this is the one negative. When rates have plummeted so quickly, there used to be positive arbitrage in the last 2 years. We're now back into a negative arbitrage situation. So there is some downside. You have to get your developers used to saying, all right, what used to be no negative arbitrage, there will be a little bit, but as you would expect, we have ways to mitigate this, both for structuring and even within the loan. So if, for example, now, if you have a non-debt service constrained loan, there are ways that you can use some of the mortgageable proceeds to pay cost of issuance, which would allow you to cover some of the negative arbitrage. So if you have in the current environment, interest rate environment, there's ways to get creative in structuring and sizing the loan to cover those costs. The many preservation deals, in order to get the numbers to work or to actually increase basis, they're taking back seller notes. We are now able, in most cases, to actually convert the seller note to a tax-exempt instrument. Just means that, again, it saves costs, increases basis, and also meets your 50% test. So if you have a seller note in any of your deals and it's a bond deal, make sure they've talked to someone or us about how they can convert that seller note into a tax-exempt instrument to meet this 50% test. In some cases, we've actually been able to avoid issuing any new bonds at all and using the seller note to meet that test. So that's a very cost-effective way to meet the 50% test and get the credits in the deal. 4 new things we have, or reiterate, that we're working on and have been working on that's somewhat unique to HUD. The first is we've been working on transactions that are refinancing before year 15. And again, just to recap, tax credit deals have a 15-year compliance period. After that, the owner can sell it to themselves as a GP and re-syndicate for new tax credits. They bring in a new limited partner. So there are many transactions, you're probably seeing a ton of them, that want to come in and refi at lower interest rates before they reach the end of that year 15. There are ways we can now structure this so that they don't have to prepay the loan, which could be at extremely low interest rates today. In several years from now, when they're ready to re-syndicate, they may want to and can keep that loan in place through a TPA, which was talked about, and we could then actually add additional debt to the project and still meet the 50% test through doing a 241A supplemental, which is why I asked the question earlier. We're starting to see more of those. We've worked on the first phase of a lot of these deals. I imagine when you start seeing these interest rates in the current environment, you'll see a lot of opportunities for refinancings. That's where you should ask if they plan to re-syndicate in the future, and if so, they should consider this option. It doesn't really add any additional cost, but there is some upfront work that can really help in the back end if you put this in place when you do the refinancing. So that's a really good option for refinancings. I already mentioned that you can use FHA now to qualify for the 10-year hold rule, so that's a good feature for developers that have projects in their pipeline or they're acquiring or they already own that have not qualified for 10-year hold. We are actually seeing very few, but there are a few issuers that I mentioned, including in Maryland, where the issuers are either requiring or strongly encouraging developers to do long-term tax-exempt bond deals backed by Ginnie Mae securities instead of the short-term bond deals that we've been doing the last decade. In large part, it does allow them to build up their bond portfolios and their parity indentures and also generate more revenues for them. There are a lot of downsides for lenders. I'll say the structure is far more complicated. There are very few people actually in the HUD offices that have seen these deals anymore because it's been over 10 years since the long-term bond deals were done. So there's been a lot of learning process or relearning, and a lot of the technology that was put in place over the last decade has really changed how those deals are done. So we are seeing it. If you have questions or you're kind of being forced into that type of structure, let us know. We can also talk about what the downsides are if you're interested offline. And the last thing that I'll leave you with that I think is going to be huge over the next 24 months that you guys may not fully have dived in yet. I know the 3-year waiver of the lockout has been terrific, especially for refis and existing deals. We've actually been working for the last 6 months on a bond structure
that contemplates a third-party construction loan with tax credit equity and a rate lock at closing on the FHA piece without a forward. It's an immediate, and it gets complicated. But it's an extremely powerful execution that we think is going to be the next popular debt execution for 4% deals for the next probably year to 2 years. So if you have any questions on that, let me know afterwards. But it's using technology we use in other programs and allowing it to be applied to this forward FHA execution after the deal is complete. And with that, that's all I got. Thank you.
All right. Thanks, Kent. We have a couple of questions here, and we'll also take some questions from the audience. And Ken, I don't know if you know the answer to this one, but question from the audience, it's when completing HEROES, what program type should be selected for a LIHTC project?
Which program? I'm trying to think of the screen of what the options are for program type. I'm sorry, I think I might have to get back to whoever asked.
Sure, that'd be great. And then another question here, as an environmental consultant, I have a developer client asking me to do a 4128 for a markup to market deal that needs a full section 106. Is 4128 really still being used for this?
For the SHPO? Could you repeat the question?
It's a developer that's asking a environmental consultant to prepare 4128 for a markup to market deal. Is that still required?
Markup to market chapter 15, as everyone knows, does require an environmental review. The 4128 has been replaced with HEROES. So, and that's, Mike mentioned the comfort letter that we're working on to try to get a consistent approval of rents prior to the environmental review being done, which is done in HEROES, and we're no longer using the 4128.
Okay, and then just a general question, with all the new favorable changes coming out in the new Chapter 14 map guide, is there any flexibility where HUD would be willing to accept waivers now before the new map guide's issued on some of those key new items?
At this point, we're not approving waivers or considering waivers for new map guide changes.
Okay, great, thank you. Any questions from the audience? Susan? And I can just a recap so everyone hears this. You know, one of the changes is extending the repayment period for the bridge loan. You know, a year after for a 223F, you've got the 12-month period to complete the construction, then another 12 months after that to repay the bridge loan. Is HUD willing to entertain a waiver to accept the new map guide changes?
Well, I can't say for sure on that. However, I will say that I believe when the 2016 map guide was published, it went into effect, I believe, in May, but it was published in January, and then it went into effect in May. And I think after that January period, we were able to consider those changes for deals that were in the works from that point on. But I can't remember specifically. I can't remember exactly. I'd have to get back to you for certain on that. Do you guys recall?
There was an implementation period that I think was a couple months.
Yeah.
But-
Susan, you were asking about deals, though, that like were under construction.
Oh, that were under
Yeah,
construction?
that are
Oh, I
currently
see.
under construction, and they have the bridge
Oh,
loan.
yeah. You know, it's a good question. I'll have to check with Tom Rediziak on that.
Okay, thanks.
But if you can get back to me, I can email you. Or I can email Charlie.
Just email me and
Yeah,
I can
that's
pass it
okay.
along. In the back, I know hand is coming.
According to my wife. question for Ken. I'm glad to see that the 20% requirement for equity has been taken down to 10 and 10. Is there any thought of taking it down even further? Because these are pretty secure deals, and you know, the lower the equity amount required up front, the higher the pay-in. It's just, I think it would be good public policy, and I'm wondering how you arrived at the 10 and the 10.
Yeah, good question. And Liz Artiego was actually, you know, working with the MBA LIHTC Committee when this was being considered. And I think the basic, the general idea, and I think everybody is pretty well aware, is that HUD wants some skin in the game from the point beginning an additional endorsement from the syndicator. So I think that's generally the reason.
Yeah, this is Ken. I think there is, almost every LIHTC deal is going to have some equity up front. I think there may be a request to reduce hard equity from bridge equity. There are often benefits to having other monies come in at closing, or bridge equity. It could be a little more beneficial. So I think you still have the money in the deal, skin in the game, but maybe a little cheaper sourcing. So I think if there is because I believe even with this modification, still 20%, right? It's not actually
That's right.
reducing.
It is 20%. However,
But
you know,
10 is actual equity under the partnership agreement, which we would argue that we're not sure that makes much difference if it's 10 actual equity versus 20% of all bridge equity.
right, and I think that, I think the general thought is that, you know, we had worked with the MBA LIHTC Committee to include some language in the new map guide about equity being available, but maybe not absolutely needed at initial endorsement because there are other sources in the deal. However, I believe that going forward we could consider that kind of thing by waiver. So to Stephen's point, there will be times where there are adequate sources available that need to be used before the LIHTC equity, and we'll be considering those on a case-by-case basis.
And the discussions we had about reducing that pay-in when we were trying to advocate for that policy, the discussions, the feedback that we got from HUD was the need to have some sort of skin in the game, and 10% seemed to be the threshold for hard equity where there was I think the minimum amount of comfort. The sense was that was the lowest that they were willing to go at that time when we were having those discussions.
Any other questions?
We must have done a great job.
All right, well, thank you, everybody.
All right, thank you. A couple of quick items. First, if you guys have tumblers from your company, if someone didn't show up, please.